In January 2019, WeWork was valued at $47 billion. By October of the same year, that number had collapsed to under $10 billion. By November 2023, WeWork filed for bankruptcy. At that moment, the market capitalization of the company, once the world's most valuable startup, was $44 million. Not 44 billion, 44 million. 12,000 employees had been laid off. Their stock options, which they had accepted in place of higher salaries, on the belief that WeWork would eventually go public and make them wealthy, were worthless. Adam Neumann, the founder and CEO who had built and then destroyed the company, had left in 2019 with a package that included approximately $245 million in stock, a $200 million consulting fee, and refinancing on over $400 million in loans. Various analyses put his total exit value at over $1.7 billion. And in April 2025, Neumann raised over $100 million for a new company called Flow, a residential real estate platform, at a valuation of approximately $2.5 billion. This is the story of WeWork, the greatest magic trick in startup history, and what it reveals about the system that made it possible. WeWork was founded in 2010 by Adam Neumann and Miguel McKelvey in Manhattan's Soho neighborhood. The idea was straightforward: lease large office spaces on long-term contracts, subdivide them into smaller units, add amenities, build a community, and rent them to freelancers, startups, and companies on flexible short-term terms. This was not a new idea. Companies like Regus, now called IWG, had been doing something similar for decades. The co-working concept existed before WeWork was founded. What Neumann added was something the real estate industry had never seen: the vocabulary and aesthetics of Silicon Valley applied to office space. WeWork didn't rent desks. It sold community, connectivity, belonging. The language of its marketing was not that of a landlord, but of a movement. Its mission statement declared that WeWork's purpose was to elevate the world's consciousness. Neumann himself was the performance. He was Israeli-American, charismatic, 6 feet 5 inches tall, and possessed of an uncanny ability to make investors believe they were in the presence of a generational visionary. He walked barefoot in meetings. He started every company meeting with a shot of tequila. He spoke about WeWork not as a real estate business, but as a physical social network and the world's first physical platform. These phrases meant nothing, but they sounded like the language of technology, and technology commanded technology valuations. In 2016, Masayoshi Son, the CEO of SoftBank, who was fundraising what would become a $100 billion investment fund, met with Neumann. The meeting lasted 12 minutes. Son committed $4 billion. He later increased SoftBank's total investment to over $10 billion, making the firm WeWork's largest backer by a substantial margin. In the casino of the new world, the one who bets the biggest wins, Son reportedly told his advisors when justifying the investment. Son had noticed that the two companies he felt had become truly transformational. Alibaba. In August 2019, WeWork filed its S-1, the prospectus that would allow it to go public. It was 359 pages long. And it was, by the assessment of nearly every analyst and investor who read it, one of the most extraordinary documents in the history of corporate finance. The losses were staggering, nearly $2 billion in 2018 on $1.8 billion in revenue. The company was losing more money than it was making, and its growth was accelerating the losses. The more it expanded, the more it bled. The corporate governance was extraordinary. Neumann held shares with 20 times the voting power of ordinary shares, effectively giving him absolute control regardless of how many investors participated. His wife, Rebecca Neumann, sat on the board and had the right to choose his successor if he was incapacitated. The conflicts of interest were detailed, one by one, across dozens of pages. Buildings Neumann owned, leased to WeWork. Companies he controlled, paid by WeWork. The trademark. The loans WeWork had extended to its own CEO. J.P. Morgan Chase and Goldman Sachs had been competing for the IPO mandate. In pitching for the business, they had dangled potential market capitalizations as high as $63 billion and $96 billion respectively. Public markets investors looked at the S-1 and declined to sustain any number above $10 billion. The roadshow never happened. The valuation collapsed in real time as analysts posted their reactions online. From $47 billion in January to under $10 billion by September, a loss of more than $37 billion in reported. Neumann resigned as CEO on September 24, 2019. His departure package was, in the circumstances, remarkable. He received $245 million in stock as part of a consulting agreement. He was offered $200 million in cash as part of a stock buyback. WeWork refinanced over $400 million in loans he had taken using his stock as collateral. Various analyses of the total package place the value of Neumann's exit at approximately $1.7 billion. A Delaware special committee later challenged the terms of SoftBank's arrangement with Neumann. The dispute settled for $1.6 billion in 2021. No wrongdoing was admitted. Meanwhile, WeWork had to reckon with its actual financial situation. The company laid off approximately 12,000 employees between late 2019 and 2020. Those employees had frequently accepted lower salaries in exchange for stock options priced against a company once worth $47 billion, now worth a fraction of that. The options were worthless. The severance was modest, typically a few months' salary. The employees who had funded WeWork's growth with their labor and their willingness to accept below-market compensation received nothing close to what they had been promised. SoftBank's Masayoshi Son, having pledged more than $10 billion to the company, admitted publicly that he had been foolish. In May 2020, he valued WeWork at $2.9 billion, a write-down of more than $7 billion from the $47 billion peak. WeWork eventually went public in October 2021 through a merger with a SPAC at a valuation of $9 billion. It continued to bleed cash. The pandemic had fundamentally disrupted the office market. On November 6, 2023, WeWork filed for Chapter 11 bankruptcy. Its market capitalization at the time of filing was $44 million. In 2022, Adam Neumann announced his new company, Flow. The pitch was for a residential real estate platform that would offer renters not just apartments, but community, belonging, and in Neumann's language, a path to ownership. Andreessen Horowitz, one of Silicon Valley's most prestigious venture capital firms, led the initial investment with $350 million, valuing Flow at $1 billion a unicorn before it had opened a single building. Housing analysts who reviewed Flow's materials described it as, in essence, a high-end landlord with a community app. The path to ownership that Neumann described had no defined mechanism. Tenants did not actually accrue equity in any verifiable way. In April 2025, Flow raised an additional $100 million, doubling its valuation to approximately $2.5 billion. When asked why they were investing in the same founder who had overseen one of the most spectacular startup collapses in history, one Andreessen partner told an industry conference, "We back founders who can bend reality. Reality, once again, appears flexible." The WeWork story is not a fraud story. Nobody went to prison. No law was broken. The accounting was aggressive, but not criminal. The self-dealing was extensive, but not illegal. The WeWork story is a story about something more troubling than fraud. It is a story about a system, a venture capital and private market system that is specifically designed to produce WeWorks. In private markets, valuations are set by the last investor to write a check. There is no public scrutiny, no mandatory disclosure, no market pressure. When SoftBank valued WeWork at $47 billion in January 2019, that became the number. Other investors marked up their earlier positions. The paper wealth cascaded upward. Nobody had to prove it was real until the IPO, at which point real investors, looking at real numbers, said no. The people who lost the most were not SoftBank, which had the resources to absorb the disaster. They were the 12,000 employees who worked at WeWork, believing their equity was worth something. They were the retail investors who bought into the SPAC in 2021, believing the story was already over and the company was fixed. And now the same founder, with the same vocabulary, is raising money for the same pitch. Not because anyone has forgotten, but because the system is designed to reward the person who can bend reality convincingly enough. This was Dark Ledger. Subscribe if you want to know where else the money really went.